Students, my name is Jesse George, your professional accounting teacher. Before you continue with this video, please subscribe to my YouTube channel, The Georgian Theory Concepts. Thank you. All right, let's get started. In this video, we are going to look at the concept of capital budgeting with taxation. All right, but before we continue, let's pause the video and write down the question, or you go through the question. Okay, so do that. All right, thank you for perusing through the question. All right, now in this question is giving the taxation. All right, how do you treat taxation in capital budgeting? All right, now a company has year end of 31st December and is considering to purchase a new machine on 1st January 2023 at the cost of 10,000. So the first thing when you see a question on capital budgeting, first identify the relevant cash flows, okay? The relevant cash flows. That is those cash flows to be included in our computation. All right. Now, since this is on taxation, of course, we have the costs of the project, the cash flows, the net operating cash flows, okay, has been given. Then we are also told that the machine will be the company intends to sell the machine at the end of the third year. So that's the lifespan of the project is 3 years. And this is also relevant. The scrap value or the residual value, okay, which is the sales proceeds when the asset is eventually sold. Then the working capital is also relevant. It's been given. We have been given the corporation tax. Don't forget, we are considering taxation in capital budgeting. All right. Then the method of calculating the capital allowance is 25%. Then the cost of capital is 10%. Okay. So you have to calculate the net present value of the project and advise whether to accept the project. So let's do that. To do this, all right, you are going to start with a preliminary computation. So we have your preliminary computation. When you are giving a capital budgeting, the first thing is to calculate the capital allowances and the tax savings on capital allowance. So we have working note 1, computation of capital allowance, annual capital allowance, and tax savings okay. So to do that, we have for year 1, we have the cost of the project. Of course, the cost of the project is 10,000. All right, so which is 10,000 naira. Okay, that's the cost of the project. Then our capital allowance for year 1, our capital allowance is at 25%. It's being given. The rate of capital allowance is 25%. Okay. All right. So what is 25% of this, which is 25? Then this will give you your TWDV. That's tax written down value. So when you subtract this, you have 750. Okay. Then for the next capital allowance is at 25%, reducing balance method. So when you calculate this, what do you have? You have 1875. Then you are going to have your TWDV, which is 5625. All right. Now for the third capital allowance, you will stop because the asset is to be sold at the end of the third year. So because the asset is to be sold at the end of, you bring in the sales proceeds. So what is the sales proceeds? The sales proceeds, we are told that it is intended to sell the assets at the end of the third year for 6,000. So if it's intended to sell the so which is 6,000. Okay. Now, when you will discover that the sales proceed is now more than the TWDV. All right, and this will give you nothing but balancing charge. That's what we call balancing charge. And the difference here is 375. All right. Now, based on these capital allowances of 25, we now calculate our tax savings. Our tax savings. Don't forget, this is negative. So our tax savings, which is at 30%. So what is 30% of this? That is 750. You calculate 875 multiply by 30%. And when you multiply, it will give you 563. Then you will not, we didn't calculate capital allowance here because the asset is to be sold for 6,000. So you now calculate your tax savings on the balancing charge. And don't forget, it's a negative figure. So it will become an outflow. So all these ones are inflows. They will come as inflow, then multiply by 30%, and this is 113, then in brackets. So this one will commence from year 2, this is year 3, and this one is for year 4. Since our tax is to be paid on arrears, now we can now come with our cash flow statements to compute the net. So the next thing now is to calculation of net present value in order to make the decision whether to accept or reject the project. So we have year 0, year 1, year 2, year 3. The project will span for 3 years, but for tax purpose, you are going to include 1 year because the tax is to be paid on arrears. That is, the tax for year 1 will be paid in year 2. The tax calculated in year 2 will be paid in year 3. The one for year 3 will be paid in year 4. That is in arrears. Now, you start with operating cash flows. So the operating cash flow for these projects is being given. That is 5, 7, and 8,000. It has been given as 5, 7, and what? 8,000. Okay. Then the next thing is your tax payable. Our tax payable is at 30% tax payable. So the tax of year 1 will be paid, that is 1.5 in year 2. The tax of year 2, which is 2.1, will be paid in year 3. Then the tax for year 3, and that is 2.4, will be paid in year 4. Okay. Then the next thing, we have our tax savings. Our tax savings, working note 1. So our tax savings, we have 750, 563, and don't forget this one comes as outflow. All right. So just bring all these figures. So this is what we want to learn here. How do we treat tax? Okay. Then you come with your cost of capital. That's costs of projects. So our cost of projects, of course, is 10,000 from year 0. Working capital. Before working capital, we can have our scrap value, which is our sales proceeds. At the end of the project is 6,000, which is inflow. Then our working capital requirement is 1,000. Is to be invested in year 0 and will be recovered at the end of the project. So from here, we can have our net cash flow, and this is 11,000 outflow. Okay, this is 5,000, and this, bring your calculator, we have a 7,000, 7,000 minus 1,5 plus tax savings 750, and that is 6,250. Then for year three, we have 8,000 minus 2,1 plus 563 plus 6,000 plus 1,000, and this is 13,463. Then for this, we have 2,4 plus 113. Sorry, 2,4 plus 113, and that is a negative 2,513. All right. Then we have our core discounting factor at 10%. This is year one. Then for this is 1909. Then for the next one, there is a 0.9. That is 1 divided by 1.1 raised to power 2. That's 0.826. Then divided by 1.1. Um, 1 divided by 1.1 raised to power 3, 0.751. Then the last one, 0.683. Okay. Then we have our present value. So you have your present value as 11,000. When you multiply this, what do you have? You have 5,000 multiplied by 0.909. That is 4,545. Then when you have 625 multiplied by 0.826, so you have 16223. Then we have 13,463 multiplied by 0.751, and that is nothing but 10111. Then the last one is 2531 multiplied by 0.683. So that is 1716. Okay. So when you add all these together, it's going to give you net present value. So your net present value is, so I'm going to add all this, then we subtract. So I'm having 4,545 plus 5,163 plus 10,111, then minus 1,716 minus 11,000. All right, and this will give me 7,103, which is positive. So now accept the projects. We accept the projects. Okay. So if you understand this question, please, if you love this video, like and share with your friends. Thanks for now. Bye.